Hello and welcome to India Business Insights. In this episode of our ongoing economy updates series, we bring to the highlights for October, mainly focusing on the Monetary Policy Committee's meeting. Let's dive into it. The Monetary Policy Committee, MPC, based on an assessment of the current and evolving macroeconomic situation, decided to keep the repo rate unchanged at 6.5% under the Liquidity Adjustment Facility, voted unanimously by all members. The Standing Deposit Facility SDF rate remains unchanged at 6.25% and the marginal standing facility MSF rate and the bank rate at 6.75%. Now let's look at the overall economic outlook. Globally, inflation is easing gradually, although still above target in major economies, imparting volatility to global financial markets. With the EMEs experiencing currency depreciation and volatile capital flows, India saw a growth of 7.8% year on year in quarter 1. Southwest monsoon rainfall recovered during September and ended 6% below the long period average. The index of industrial performance rose by 5.7% in July, and core industries output expanded by 12.1% in August. CPI headline inflation surged by 2.6% to 7.4% due to a spike in vegetable prices. Core inflation softened to 4.9% during July-August 2023. On the demand side, urban consumption is buoyant and investment activities benefiting from public sector capex. Services exports improved, but merchandise exports and non-oil imports remained in contraction in August. According to the RBI governor, on sales of government securities on the card, we may have to consider OMO sales, that is open market operation sales, to manage liquidity consistent with the stance of monetary policy. The timing and quantum of such operations will depend on the evolving liquidity conditions. According to the RBI, as of September 22, 2023, money supply expanded by 10.8%, bank credit grew by 15.3%, and further, Forex stood at 589.9 billion US dollars as of 29 September 2023. CPI inflation is projected at 5.4% for 2023-24 based on expected improvement in vegetable price correction, lower area sown under pulses, dip in reservoirs, and services and infrastructure firms expecting a moderation in the growth of input costs and selling prices. Additionally, looking at the projection of real GDP growth for this year is projected at 6.5% with risk evenly balanced. Since demand might benefit from sustained buoyancy in services and revival in rural demand, consumer optimism, and healthy balance sheets. The headline inflation is ruling above the tolerance band, and hence monetary policy needs to remain actively disinflationary. As stated by RBI, domestic economic activity is holding up well and is expected to be boosted by festive consumption demand, a pickup in investment intentions, and an improving consumer and business outlook. The MPC also decided to remain focused on the withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Now let's talk about the Consumer Confidence Survey. The RBI recently released the results of a bi-monthly Consumer Confidence Survey. The Future Expectations Index reached a 4-year high, indicating the prospects for employment, income, and spending are expected to improve. The Current Situation Index also reached a 4-year high as households are optimistic about future earnings. Though price expectations for the year ahead remain negative, respondents' pessimism on this front has moderated in the latest survey round. Periodic Labour Force Survey Annual Report 2022-23 NSSO released its 6th annual report this month, considering the importance of the availability of labor force data. Some of the key findings include an increase in LFPR from 50.7% in 2017-18 to 60.8% in 2022-23 in rural and urban areas, from 47.6% to 50.4%. Further, there is an increasing trend in the working population ratio and a decreasing trend in the unemployment rate for persons aged 15 years and above. The urban unemployment rate fell even as the labor force participation rate increased by 30 basis points to 48.8%, the government's latest periodic labor force survey showed. As per the Statistics Ministry, unemployment rate for persons of age 15 years and above in CWS ranged from 7.8% to 9.7% during the pre-pandemic period. The unemployment rate during April-June 2023 was 6.6%, which is lower than the unemployment rates observed in the quarters covered in the pre-pandemic period. Now, we'll discuss about the GST collection. The gross GST revenue collected in the month of September 2023 is rupees 1,62,712 crore, out of which CGST is rupees 29,818 crore, SGST is rupees 37,657 crore, IGST is rupees 83,623 crore, which includes rupees 41,145 crores collected on import of goods, and cess is rupees 11,613 crore, including rupees 881 crores collected on import of goods. The revenue for September 2023 is 10% higher than the GST revenues in the same month last year, as domestic transactions are 14% higher, and it is for the fourth time that the gross GST collection has crossed rupees 1.6 lakh crore mark in financial year 2023 to 24. Monthly review of accounts of Union Government of India up to August 2023 for the financial year 2023-24. According to the press release by the Ministry of Finance, the Government of India has received rupees 10,28,931 crore, 37.9% of corresponding BE 2023-24 of total receipts up to August 2023, comprising rupees 8,03,944 crore tax revenue, which is net to center, rupees 2,09,582 crore of non-tax revenue, and rupees 15,405 crore of non-debt capital receipts. Total expenditure incurred by the Government of India is rupees 16,71,757 crore, 37.1% of corresponding BE 2023-24, out of which rupees 12,97,958 crore is on revenue account and rupees 3,73,799 crore is on capital account. Out of the total revenue expenditure, rupees 3,67,539 crore is on account of interest payments and rupees 1,80,739 crore is on account of major subsidies. India's consistent innovation excellence, retaining the 40th position in Global Innovation Index 2023. India stands at 40th position out of 132 economies in the Global Innovation Index, reflecting a remarkable journey from 81st rank in 2015. Additionally, India emerges as the numero uno among 37 lower middle income group economies and stands tall as the number one innovation performer among the 10 economies in Central and Southern Asia, as our country consistently outperforms expectations and excels in various indicators. It stands poised to drive economic growth, foster resilience, and embrace self-reliance through innovation. Let's talk about India's Forex reserves. Foreign exchange reserves are the assets held by the Reserve Bank of India in foreign currencies, which act as a cushion and provide liquidity, hence aiding in maintaining the stability of the nation's currency and economy. Recently, there have been many fluctuations in the Forex reserves, reflecting the current economic outlook. At the end of the first week of September, India's Forex reserves stood at $598.897 billion as per RBI. Earlier, It was $601.453 billion on August 4 and stood at an impressive $609.2 billion, marking 15 months high. Further, it fell for a third straight week and was at a 4-month low of $590.70 billion as of September 22. Reserves had fallen by a total of $5.9 billion in the prior 2 weeks. You wonder why? Well, the central bank at times intervenes in the spot and forwards markets to prevent runaway moves in the rupee. The RBI has been lightly selling dollars to prevent further depreciation of the rupee. The other reason could be changes in foreign currency assets expressed in dollar terms. For the week the Forex reserves data pertains, the rupee had risen 0.2% against the dollar and traded in a range of 82.8225 and 83.2725. Therefore, to prevent the rupee from falling further and ensure orderly moves, the RBI sells dollars via public sector banks, and revaluation has also contributed to a decline in reserves. Meanwhile, the rupee appreciated 14 paise to settle at 83.5, which is provisional, against the US dollar on 29 September, boosted by a firm trend in equity markets and a sharp correction in the greenback against major rivals overseas. Now let's move on to one of the most significant developments, which is the inclusion in JP Morgan Global Bond Index. India will join the GBI EM Global Diversified Index with a maximum weight of 10% and gradual inclusion starting from June 28, 2024. As per experts, this inclusion could potentially attract approximately 25 to 30 billion US dollars in inflows, reducing the yield on government bonds and lowering borrowing costs for the government and corporations. Given the current economic situation and India's improved economic fundamentals, it is an opportune time for inclusion in the GBI EM index. As stated in a recent release by JP Morgan, India's local bonds will be incorporated into the government bond index emerging markets GBI EM index and its index suite. These are benchmarked by approximately $236 billion in global funds. India is working on inclusion in other global indices, which could further enhance capital inflows into its debt market. As stated by Chief Economic Advisor V. Anantha Nageswaran, there is a potential for currency appreciation when the index inclusion starts to happen and the demand from investors for Indian government securities starts to rise. Now let's move on to foreign institutional investments. In September, FIIs sold around $2.19 billion in local equities, the highest level in 6 months, after investing around $17 billion since April. As bond yields in the US start to rise, investors switch out of foreign markets, especially emerging markets, to hunt for better opportunities at home, which pressures equities. We track FDI flows on a 12-month rolling basis, and it gives us some sense of the trend ahead. On a 12-month rolling basis, FDI flows turned positive only in May 2023, after a long gap after December 2021, said Gaurav Dua, Senior VP and Head Capital Market Strategy, Sher Khan by BNP Paribas. Normally, the 12-month rolling remains posted for 10 to 12 months after moving from the negative to the positive side, Dua added. India Service and Manufacturing PMI, the S&P Global India Services PMI, increased to 61 in September 2023 from 60.1 in August, beating market forecasts of 59.5, signaling a sharp upturn in output that was one of the strongest in over 13 years. Employment continued to rise, with the pace of job creation moderate but above its long-run average, while backlogs of work continued to expand. The rate of accumulation was marginal, slower than in August. Further, business sentiment improved to an over 9-year high, fueled by buoyant demand conditions. The S&P Global India Manufacturing PMI slipped to 57.5 in September 2023 from 58.6. It was the 27th straight month of increase in manufacturing activity, but the softest pace since April, as output expanded the least in 5 months amid a slowdown in new orders. Also, growth in foreign sales eased from August's 9 month peak but remained sharp. Meanwhile, employment picked up and was strong by historical standards, while backlogs fell fractionally. Finally, confidence hit its highest in 2023 so far, supported by buoyant customer appetite, advertising, and expanded capacities. Now, let's talk about high frequency indicators. India's growth is expected to maintain its resilience led by festival demand, which is expected to be reflected in this quarter. 10Y benchmark yield movement was striking in October 2023 with 13 BPS jump till 10th October. A major sell-off was seen post-monetary policy with RBI's announcement of OMO sales. Going forward, pressure on domestic yield will persist. Even INR has remained under pressure due to a global risk of sentiment. The domestic demand is expected to improve and the fiscal deficit ratio decreased slightly from 6.4% as of August 2023 to 7.1% as of July 2023, led by a steep revival in revenue receipts. Within this, direct tax receipts jumped by 26.6%, minus 1.1% as of July 23, and indirect tax collections were up by 7.8%, which is 6.9%. Moreover, INR depreciated to a record low and the 10Y yield rose by 5 BPS on September 23. RBI intervention is likely to prevent the rupee from depreciating further. Thanks for watching. Like, share, and subscribe to the channel, and don't forget to press the notification bell so that you stay updated.